It's Ian Nelson with eXp Realty here. I'm just popping over. Just finished a really amazing little insight group this morning with a bunch of realtors and some lenders. Got a lot of great facts for you, ready to share, and I will kind of decipher as much as I can. There's a lot of information here today just to kind of give some clarity in the market. I'm sure you've seen tons of headlines, tons of different news clips, YouTube videos, anything like that, all kind of reporting doom and gloom, all that clickbaity sort of stuff. But I wanted to bring you guys a little bit of value, a little information, so hopefully we can kind of clear up some of those doubts that you have in the market here, or if you've been waiting to buy because the prices are supposed to be dropping and coming down, bringing some context and clarity to that as well. So if you bear with me just a second here, I will share screen with this. And right here is a great little walkthrough that I did this morning. All of these slides come from a great lender. His name's Eric Hamilton out in Downers Grove, but he works all over the Chicagoland area. And we had a lot of topics to discuss, a few main areas here. So you're going to see his picture pop up a little bit, and I'm going to be sure to tag him on this video. That way he can get credit for all of this hard work that he did. But let's get started. So do you have a relevant opinion based on facts? Most people can probably gather most of their news sources, big national networks, different online sources, all that sort of stuff. But are they trained professionals? Are they reading the data correctly? Or are they just pushing through headlines that are meant to kind of scare people? Let's see if we can figure this out. Is the market going to crash? We'll find out. What's happening with mortgage rates? We'll get there. We'll kind of see what happens if the economy slows. But the big one over the weekend that a lot of people were talking about are these LLPA rates, and what those mean to buyers with good credit, with bad credit. This is a little thing from Eric here. It looks like the media got it wrong. They're pushing out the stories before they got the facts, or before they actually really looked into the numbers. They're going to say you're going to get a 1% surcharge on people doing this, and the people with lower credit scores are going to get a discount on these LLPAs. But to put context to that, you can see here we got a couple of different bad headlines coming from credible sources, apparently New York Post, US Today, Fannie and Freddie. But what does that mean for everybody? These FICO scores are going to get a discount on the LLPAs. The higher FICO scores are going to have a 1% fee. That's just to kind of close the gap on what people can afford. And that's mostly for people that are putting less than 5% down on a home. A lot of FHA buyers, stuff like that. It's going to bring some more people into the market. It's going to kind of help a little bit with affordability, but it's not going to be punishing anybody with those things. So if you have a 740, you're still going to get the best rate on the market. If you got like a 640, you're going to have a little bit lower or higher of an interest rate on your loans, but the rate of affordability is going to be a little bit better. And these fees are actually usually paid by the lender. So whenever you get to, scroll through this, pause, read into these little captions down here, it's not a cost that's really coming to the consumer directly. This is more or less for those loan originators that are then selling the loans after they're completed, and those service fees that the lenders have to pay. We'll get down here, and then this is kind of where they got those numbers that they were reporting. You can see 80% people who normally put like 20% down on a house when they're purchasing a home. With the higher credit scores, those LLPA rates, not the interest rate on the home, are going to be penalized a 0.75 surcharge, while those putting 20% down with lower credit scores, they're going to get a little forgiveness there on that, like 0.75. So you can tell that the differences in information in the way that it's coming out, it's not really going to hurt people. He put together this slide right here based on a $600,000 home purchase. So this person right here is your super high credit score. You can see they're going to get a really good rate, 6.5%. This is based on last week's numbers. I know that they did come down a little bit this week, but they're going to be bouncing around quite a bit until a little bit after June, and then we can start seeing interest rates coming down more gradually. But there's more to keep in mind once these interest rates start coming down. So as you can see here, it's 780, 740, 680, 660. This is what's going to be happening in your pricing and for those interest rates coming through. The LLPAs take effect onto these projections as well. So the difference between the low end and the high end credit people is you're going to have about $483 in savings per month on the same home. So it doesn't hurt the people with the better credit. It does benefit a little bit more of the loan that the bankers are trying to pass along to secondhand mortgagors. So that way, we can keep the housing market moving along. Here's what's going to change on May 1st. We're going to have higher credit scores needed to obtain the best rate. Anyone 740 and higher will be placed in the low risk bucket. Moving forward, 780 is going to be needed. So they're going to bump it up a little bit on the credit requirement. First-time buyers, loans with 3%, typically reserved for first-time buyers, now have lower fees. And similar loans for borrowers putting 5 and 10% down. Borrowers with lower credit scores get some help. The fees for the credit scores of 679 or lower are lowered on all down payment scenarios under these new changes, leading to lower rates for these borrowers. Higher credit score borrowers with medium down payment rates are comparatively the ones that are the worst off. So if you have a home that you're selling and you're going to get into a new home, maybe down the line you can just put your 5% down, take advantage of your high credit score and the fees that go along with this, and then once you sell your other home, kind of get a little refinance go on your mortgage there, and then pay off more of that mortgage later on. If you want to get into the nitty-gritty details of that, I can always connect you with Eric. He's an amazing lender, and we can talk more detail into that. Other things that are really, really bad for people right now are the headlines. They do more to terrify than clarify, it says here. So if you want to look around these different kind of providers here and these headlines, Americans worrying about losing their jobs as recessions grow, why investors are increasingly worried, another 2008 housing crash, or worse. This person got 1.1 million views 9 months ago. Something that was 9 hours old, 15,000 views. The Great Housing Depression of 2023 through 2030. These are all predictions that are just based off of bad headlines, and I don't know if they get into the data. But all I can tell you is if we were to put out a video trying to help people, let everybody get clear information through these things, probably only get about 300 views. So it seems to be the ones that are trying to scare everybody. The videos move around like wildfire. Even some of our great news channels and sources are going for these headlines as well. So you always just got to take it with a little bit of a grain of salt, and then consult with a professional. We're going to be the ones that are going to help you get through these times. We're going to help make sure you understand what's happening in the market. We're going to make sure you have the confidence moving forward and making the purchase that you need to do and set yourself up correctly for being successful. Buying a house is not an instant gratitude or an instant growth in investment. There's a lot that's going to happen over a certain amount of time, and then we'll get into how appreciation's been working in the United States for the last 70 plus years or whatever. But here's some other big fears people were getting through. Housing bubble fears. This is some of the headlines, and then over here on the right is actually what happened. So like in 2015, housing bubble, or housing today, a bubble larger than 2006. Well, actually, homes appreciated 5.1% that year and gained on a $300,000 home about $15,000. Same thing the next year. We're in a new housing bubble. Homes appreciated 5.4%. These are just kind of nice baseline average appreciations nationally across the board. And then, we get down into 2019. Next year will be hard on housing markets. They were expecting a big boom in 2020 before the pandemic even happened. And then the pandemic just flew everything off the handle. So these 2 years, you're seeing 16, 18% growth, and that's a national average. And, that's also contributing to where you see the market coming down in 2022 and a little bit of 2023 here. That's just averaging and leveling out to where we should have been without that giant pandemic spike. So, like we said, a lot of, headlines. You got to make sure you're understanding what's the context behind these headlines, because the headline is really not going to point you in the right direction unless you know the source. Even some more stuff from these bad headlines. Bloomberg, they're very credible. CBS, MSN, Realtor.com, they're all talking about foreclosures happening and everything. Oh, we got double the amount of foreclosures and from this time last year. But over the pandemic, we had a moratorium. Nobody was processing foreclosures. Homes weren't allowed to go into foreclosure. So, when we get down to those levels that people are looking at, 151,000, that's in 2021. Then the moratorium lifted. Obviously, we're going to get an uptick in what's happening, but pre-pandemic levels, we were up over this line, and now this is the level that we're at for 2022. That's what we hit in the cap. It may grow up a little bit in 2023, but as we were trending downward. So maybe it's going to end up getting back closer to this 2019 level, but it's still below the average of the previous 5 years before 2019. And if you look at how all the foreclosures worked in the past, guess where this was? The housing bubble that everybody is scared of, 2008, complete anomaly. But this brought us all the way up into housing numbers that we've never seen before, because there was lending practices that were very predatory and people couldn't afford the houses that they were being put into. Everything is much more regulated these days, bringing things into a much tighter level. Here's that drop off when the moratoriums happened, and then there's now just gently climbing back up into those foreclosures. Another look at it and on the same scale, but in a bar graph, in case you're a little more visual into where the numbers are. Today's nothing like 15 years ago. So when we did have all of that stuff in our last housing cycle, jobs that were cut in this recession, 8 million. We haven't had really any jobs cut. There's been people laid off, but our job market is virtually too strong to cut all the jobs. So, in the household survey, total jobs at that point in time was 138 million. Currently, right now, we have 158. Subprime loans, they were all over the place. That's what got everybody underwater in their home when the banks crashed. Those aren't even really in existence at all anymore. I mean, there might be some people who are still in that home from 2008 that they purchased, or 2007, 2006, but their home isn't really subprime anymore. They've gotten appreciation, they've gotten value out of it. They survived that crash if they didn't have to sell that home, or if they didn't go into foreclosure. New construction that's happening then, we were building houses like crazy. We had more demand, or less demand. We had more houses than we could actually fill. There was points in time where construction was happening in neighborhoods, and then after the crash, they just kind of stopped in the middle of building a cul-de-sac or something like that. But builders were buying like crazy, buying land like crazy, building houses like crazy, building houses without even having demand for it. And right now we're, you know, we're actually right at 1 to 1.2 million houses on the market. And 60% of those are actually under contract in the off market opportunity. So we're still sitting around like 450, 500,000 homes that are actually available nationally. Here's a little definition of what, you could kind of see from inflation. And this is a number that is actually kind of surprising to myself, because I do try to, live within my means. But for every $16 or $17 in the economy, 16 of those dollars are coming from a loan source, whether that be credit, a bank loan, or what have you. And why that's important? Because inflation drives mortgage rates. Over here in the blue line, we can see the 30-year fixed rate and where we were at. And when we came into the pandemic era, we were already sub 4 on those loans. And then we started to see right here the rise of inflation in 2021. This is actually when they should have, quit the quantitative easing and then just started going along with inflation. But there's a lag in that data, and we didn't see that stuff coming nationally. So as things continue to rise, we hit our peak up here at 7.5. But as you can tell, since probably December, November last year, everything's starting to come back down. Inflation, like we said, on its way down. So let's see, September was when it started to turn, and now it's been going down ever since. Inventories are building. A lot of people have, or a lot of stores, a lot of businesses have that inventory that they've been, that they ran out of during the pandemic because of the shutdown. Everybody ran out of, toilet paper. We got a shortage on eggs. We had all of those things happening. And now everyone is filled up. They're back up way above levels of stock that they ever had before the pandemic. And now you're going to see a little bit of discounts coming on that end, hopefully to just kind of get rid of inventory. Shelter costs are lagging. That just means the data that the Fed is using comes from a point in time where it's not reflective of where we currently are. So you can see on this curve, this is, the apartment rates of rent, and those are starting to come down, but they're higher than they've ever been before. And if you can see the shelter year over year change, it's just been a very slow, gradual line, and now it's starting to come up. Those prices are coming up because we have an inventory issue. That inventory that we need in the market, it does tend to come up right now this time of year, spring going into the beginning of summer, but it starts to taper off again. So just to kind of show how the lag is, it's like this is where we're at with the real shelter costs, but this is where they're reading it on the CPI level. So as it comes up, we're already heading down. And that's just showing that lag. Mortgage rates, recently we were at 6.21, but all professionals I talk to say that this 5.5 feels like the threshold of affordability, and that's when the market's really going to get flooded with buyers. I've been seeing it as soon as anything gets to 6.25, 6 or below, I'm expecting a lot of buyers to jump into the market. So those people that can afford right now should be searching for homes and trying to buy and lock in their housing price, because if we get any more buyers into this market, a lot of those high desire homes, the ones that have high traffic on them already, are going to possibly be getting back into those multiple offer situations. Probably not nearly as aggressive as we saw in the pandemic, because these loans are not as affordable as they were then. But with the interest rates, you're going to have a few more people bringing a lot more cash to the table and fighting competitively for some homes, giving up contingencies like inspections and waiving some of their buyer privileges so they can purchase these homes. in competition. But everything going good. Mortgage rates are trending lower. We have another interest rate hike happening in May 3rd, I believe. They're going to bump it up another 1/4 of a point. But that should be the last one. And from what I'm hearing, there's potential that we could possibly even see 4% rates, rates in the 4s, I should say, by the end of the year. And if you think about everything on a timeline, had we, taken 3 or 4 years to get up to this 7.5 interest rate, it could have been a very long, painful time for people trying to buy homes. We just recently experienced all of this rate hike and the rates coming back down over like an 8-month period. So relatively speaking, it was very short, very painless. The adjustments are starting to level out, and we're seeing all that relief that's going to be coming through. This shows you how the buyer demand has been working with the interest rates as they've been so volatile over the last, 6-7 months. And like I was saying before, anything in that 5.5 to 6 range, you're going to have super strong buyers entering into the market. That's a lot of demand and not a lot of inventory. Usually recessions mean that the interest rates are going to be falling. This is of the last 6 recessions and what happened with the mortgage rates around it. In the 80s, they were able to drop quite a bit, but that was when people were purchasing homes for like 12, 13, 15% interest rates. In 91, they had another drop after that recession. But this one here shows how mortgage rates are usually related to the 10-year treasury yield. Typical normal spread, 175 to 200 basis points. Currently, through our inflationary periods that we've been in, we're at 300 basis points. That means, where the rates are now and where the 10-year treasury yield is got about 300 basis points in between that degree. So when we hit 7, the 10-year treasury was at 4. If it was back to normal and where it needed to be, it should be like 5.25 to 5.75. But we're not there yet. We're getting there. Underlying births, this is an interesting thing, mostly just for realtors, but there's going to be a lot of buyer activity hopping into the market because statistically, a home buyer purchasing their first home is buying their home around the age of 33. Right here, you can see millennials. There's 66 million millennials compared to 55 million Gen X. And once they hit 33 years old, you're going to have about 4 million of those people in the 33-year-old range purchasing or wanting to purchase or being near purchasing a home. And then that's just continuing to rise. So that demand's going to be there. Housing demand, household formations average 1.3 to 1.7 million households per year. So that's people coming together, getting married, wanting to purchase a home, individuals wanting to get into the market, purchase a home, first-time buyers, all that sort of stuff coming into effect. That's what we consider the demand for coming into the home. Now, new housing starts, that is 1.4 million. We destroy about 100,000 homes nationally every year just from them being, tear downs or whatever, reconstructions, things that need to actually just be taken out of the market. So we'll make that number 1.3 million. And builders are cautious because they learned their lesson from, the 2006 to 2009 period. They're no longer just freely building homes as fast and quickly as they possibly can and just expecting buyers to get in. Now, they're just kind of building to order almost. And, they might end up having orders to build like 30 or 40 more homes in certain areas, but they're not going to build more than they can sell. So it's going to take a little while for these numbers to catch up. There's 14 million more households, 2.5 million fewer homes. on the market. Our average days on market for most of those homes has been 14 days, and 82% of homes sold in less than 30 days. So things are moving quickly in almost all markets. And you can always kind of expect things to sell as long as they're priced appropriately and have the correct marketing and everything around them. The ones that linger, they tend to be overpriced, and that's what the market will tell you. It leaves you hanging there for quite some time. I've seen places that have been on market for 100, 120 days, 200 days sometimes, and it's mostly due to pricing being the issue. Inventory. All right. So here we are right now. This is 2023. We're heading into, so this is January, February, March, April. We're at April. Things are always going to start coming up right between March, April, June. That's a typical ramp up for spring market because of the interest rates related to mortgages. We've seen a little bit of a delay on that this year. So our spring market, our big market, is probably going to be more like May, June, July, and maybe a little bit of August. So, keep in mind that, a lot of this is going to be going up. This is some, estimates on how the trend's going to keep going. We'll get more listings this year, but they're going to move fast because that demand is still there. And if, in June, when we're expected to see mortgage rates starting to drop, we're going to get a lot more buyers. So a lot more buyers are going to be entering into the market, and all this inventory will get absorbed quickly. So, if you're looking to sell, that's going to be a great time to get onto the market because we're going to have so much demand. People looking for homes. People really want to get into homes because renting is really not the most ideal option. If you're asking me, if you're asking anybody, the American dream is still to own a home. Right now, 8% appreciation over the next, or over next year after the bottom, even with 2.4 million. This was way back in 2012. They had that kind of growth after the bottom. So when people bought in the bottom, it's hard to time the bottom. Many people already say we hit the bottom already at probably about February this year, when we had a really small window of great interest rates and people went out and absorbed up a lot of inventory. That might have been that bottom that we had for this year. So if anybody's been waiting for the market to bottom out or get to the crash, you might have already missed it, and we're on our way back up again already. So as we have for inventory right now, existing homes on the market, 980,000. Sorry about that. 402 under contract or off the market. So actual active listings nationally, 578,000. That's all around the country. Chicago, we could have, anywhere from 20 to 25,000 active on the market. And how many of those are, full gut rehabs? How many of those are in, small condos that need to be updated? How many of those are, different types of properties? So like the options are there, but there are limitations, and just understanding what you can do with those. Another sidebar, I spoke with another lender who solely works in just renovations. They have a lot of really cool products now. If you're having trouble getting an offer accepted on like that turnkey home that you're looking to get into, there is the option of getting one of these renovation loans. There's 4 different types. One for veterans, there's an FHA one, there's a conventional one, there's one from Freddie. Any of those options, you can find a home that's not perfect for you yet, and then build everything that you want into that home, into that renovation, as long as it fits in the parameters and the confines of that loan. And, buy a house that you think is great. It's got good bones. It doesn't need a lot of work, but you want to get a new kitchen, a couple bathrooms put in there, finish out a basement, something like that. You go through, you get that work quoted out right in the offer process. And have everything lined up, ready to go. And those renovation loans allow you to build a house that you really can be happy and proud of. Rising inventory, it's on its way up, but this was that number of total homes. That's including the ones that are off market, you know. And here's what our normal cycles look like. So if you've ever heard anybody in real estate talk about how cyclical the market is, this is what they're talking about. This is January, each of these lines, every dip, that's January. And this is how the market always goes. So you have a big ramp up in spring, and then it goes through the summer, and then a little bit of the fall, and then by the time you get to October, it starts tapering way down, and then December and January hits the bottom because everybody's, you know, with their family for Christmas. They're doing New Year's parties. They're traveling out of country. They're going to tropical areas in the Midwest, or from the Midwest here, getting to that sun. And then school starts coming back into session in January as well. And then things start picking back up again. So that's what a normal real estate cycle looks like. And this is where we're at now. So these are inventory levels. This is what we've been dealing with. And because they're not building enough new homes for people to get into, this is the point that we're at now. And that's going to be the battle that we're going to go through for the, you know, foreseeable future. Inventory. That's going to be our fight, but it's not going to be our problem to find homes. There's going to be homes to find. You just got to be diligent. You got to be ready, and making sure when you get into the market, everything is lined up and you can make the most strategic, best moves possible. If you want to find some really good strategies, I've been, you know, ear to the ground, understanding what's been working in these markets. Don't hesitate to reach out. I'm always happy to help. Here's just a source of, you know, who's saying we are short of homes. Like, all these different sources here are reliable sources telling us that we're in a housing shortage. We're short on homes. They're not making enough new homes. And that new inventory is all being absorbed. So average this out, you're looking at like 2.2 million nationally that we're short on homes in demand. And what that means for housing prices is they're pretty much going to stay or keep growing. Reasons why millennials want to, you know, why they're still renting is they're waiting for prices to come down. They're really not going to be going down. Not to an extent to where you see like dramatic affordability changes. You know, you're not going to see a home drop like $50,000-$60,000 in value right now because of that inventory issue. So if you've been waiting for the prices to come down, best thing to do is buy a house and then wait for the interest rates to come down and refinance your home so you can get a cheaper payment. But if you can afford a little bit more than what you're paying right now in rent to buy a home that you would be happy and comfortable in, first step into growing into more wealth is purchasing a home and then leveraging that home into the purchase of your second home. That is going to be a key jumping factor, and how many people actually grow their wealth substantially is they use their first home to jump into a second home. So, you know, while you're there 2, 3, 4, 5 years building equity in there, you are gaining enough money in that equity gain, and then also the appreciation of your home. So that way you can purchase higher on that second home. So if you're, you know, finding an area that you want to stay in for a while, then you know that you want to be there, it's a good time to buy. This was that one graph I mentioned earlier, going all the way back to 1942. So like 70 years of real estate data, all here from like the US government. And this is what's happened in the housing market, appreciation wise, on home values. So right here circled, that's the great housing bubble. Everything dropped, fell. It's only gone down one other time in all of our history, and everything else all we've seen is appreciation on homes. That's why they say the safest hedge against inflation is owning a home, because these appreciations happen. You know, sometimes you got some zeros in there, or you only get a 1% appreciation. These are national averages on the screen. But what you do know is over time, and more often than not, you're going to be on a 30-year mortgage, your home's going to appreciate in value. You're going to gain on that investment. Not only are you paying to fully own out that home with your mortgage payments and buying equity in the home, your home's appreciating at the same time. So your equity is growing with that appreciation and the paying of your mortgage. So the more and more time you have to put into a home, the more you're growing your actual wealth. So this has been my favorite graph for the last 2 weeks. I want to share it with everybody. A little context to all of us in the Midwest here. We're in the more stable markets of everywhere in the country, but if you bought a home in 1991, which my parents did, or they bought in 1990 or 89, something like that. But in these areas, especially Chicago, Illinois, since 1991, your home appreciated 168%. Now, there's some other areas around the country where people have been investing. There's been growth in tech sectors and stuff like that. You can get some crazy numbers, like Colorado went up 574% since 91. That's a lot of growth. But you know what can happen when the prices start leveling out and adjusting? You're going to have larger dips in leveling out those prices. The great thing about the Midwest and where we've been in our markets is we've had little rates of growth, but then we have little rates of fall. So, those negative years are the years that we're not appreciating at the, maximum value that we've been getting. It's only appreciating like, 1, 2, 3%. And then, on the good years, we're getting 3 to 6% appreciation on our homes. So our sine wave is just nice and level. And these other markets are like, whoa, way up, way down, way up, way down. That just, brings a lot of comfort knowing if I purchase a home here in Illinois, I'm going to comfortably know over time my investment's just going to grow. It's not going to really affect me at any point in time. So you can see here home appreciations. Most of these areas, Chicago, January year over year in the top 20 cities, we grew 4.8%. I used to live in Minneapolis. They had an appreciation right there, 1.7. These other markets, they've had a little bit of up and down. You can tell right now West Coast is kind of getting hit hard with everybody just kind of moving away from their tech businesses and stuff like that. So these adjustments are, hitting them a little bit harder than it is for us. But I mean, we're still expected to keep appreciating this year as one of the more stable markets. We'll get into where's the opportunity this year. Did you know 67% of Americans say housing market crash is imminent in the next 3 years? We're not seeing that. Before the bottom, right here, U.S. Current market as an opportunity. Difficult to get the exact bottom. I just talked about that not too long ago, maybe a few slides. But before the bottom, the seller is, more fearful, but there's less competition. And then after the bottom, the seller is more confident because there's more competition. But the bottom's going to bring in that competition for the savvy buyers. And then the people that realize that they missed the bottom are going to be chasing the bottom. And that's where all that extra competition in the buyer market is going to be coming from. Because, most people are behind on the headlines and they're not getting the right information up front. They're not consulting with their professionals. So as we've already discussed I believe we've already hit the bottom and we're on our way out of it currently right now. So all of those who have been waiting for the market to bottom out, prices are going to stay strong, possibly even grow as this buyer demand keeps ramping up as we see these mortgage rates come down starting likely in June. Here's our savings rates. So this is what was interesting. Going into the pandemic, U.S. household savings rates were at the highest that they've ever been. People were able to save money. They were able to put away for lots of things. They had money to possibly buy second properties. They were saving at a rate that was just substantially stronger than any time that we've ever had in our country. But then we get to now, in inflation, we're saving at the lowest rate that we've ever been at. So as that keeps going, you can see that's mostly due to our consumer debt. Consumer debt being lines of credit, credit cards, loans, all that sort of stuff. Did you know the average car payment in the United States in 2022 was $800 a month? That's a very, very high car payment. That's a lot of debt onto the debt to income ratio. That's what's driving a lot of these factors. And those are the things that are kind of scaring people out of buying the market right now, currently at the rates, because they have that extra car payment. They have, the looming debt of credit cards. The average household right now carries anywhere from $20,000 to $30,000 in credit card debt. And that's extremely high. That's all due to this inflation. People are not spending that money that they had, or they already spent that money that they had saved, and now they have to use those lines of credits to keep going. Addressing move-up buyer concerns. Households increased the fastest pace in 15 years due to hefty increases in credit card uses. Debt surged over the past year due to the inflation running near its highest pace in more than 40 years. Debt surpassed 870 billion peak in 2008 financial crisis. Currently, right now, we're at 930 billion in debt. Like, that's just credit card debt in all of America. And that was our financial crisis in 2008. This is a 50-60 billion dollars in difference there. Credit card delinquency rates were at 0.16% from the prior quarter to 5.2% now. Younger Americans, 18 to 29, have 76% higher delinquency rate than anyone else. You hear that, Gen Z? You're spending too much money. Addressing move-up buyers. So let's look at like a client who owns a home, $485,000. They got a remaining mortgage balance, $292,000. They're got one of them great interest rates, 3%. Tax and insurance, $850 per month. They want to upgrade their home, buy a little bit bigger because their family's growing. Pretty standard issue of what happens with people who own a household. $600,000. They're able to sell that home and put down $150,000. So their mortgage payments, or their new mortgage, is less than what they were doing before, but they got $450,000 at a 7% rate. You got $1,270 per month. That's a shock. That's what's scaring people. And then if you look at it on a thing right here, current property, 3%, your total equity after your sale was 193. You're spending 150 of that on your down payment, making your mortgage there. Here's what the problem is. Your current monthly payment was $2,300. Your proposed new monthly payment, $3,600. That's $1,300 in price shock. So you have to manage your debts, making sure your credit card balances are low, keep them low all the time. The car that you purchased, you don't want an $800 a month payment, and it doesn't look like that those are going to be around for forever, but the prices will come back down. Or if you are this person that is selling a home and then you only used 150, you got that extra $43,000, pay off that $800 a month car and get rid of that big chunk of debt there. But for purchasing today, you get to lock in today's rates and increase in price from the low inventory. So as you lock in today, where there's less competition, you have the price locked in. The rate is going to change eventually. You can refinance in a year. You can refinance in 6 months. It's not really going to cost you that much. and possibly in the savings that you get if you get the great rate, you're going to pay yourself back in a year. There's less competition right now. Lock in the rates. If the rate moves back higher, you're locked in at a lower rate, negotiating better terms, so you're actually getting to get inspections on the home. You don't have to waive contingencies. If you have to sell a home to buy a new home, you're likely to be able to actually do that instead of having somebody who can purchase a home in cash and then wait and sell their home on the other end. So no need to waive anything on your appraisals and contingencies. Or you can wait to purchase and come into the market when there's more competition. Once the spring market starts, which we're predicting that later spring market where things in May, June, July are going to be ramping up, inventories are going to be coming up, but also buyer demand is going to be growing as well with those lower interest rates. Prices will be higher due to the increased demand. Some people will be paying over list price. Some people are going to be waiving contingencies. They're going to get in and going to be like, I don't care about the inspection. I'll get one just for my own personal information, but you're not going to get any buyer or seller corrections. You're not going to get seller credits to closing costs. You're not going to be able to negotiate anything from the sellers because they know that the demand's there and people are willing to pay for that home. So option 3, you can get fully pre-approved today with a commitment letter. That doesn't cost you anything. It's not a mark on your credit. It's not going to really do much except benefit you. It's going to keep you, from chasing the market. It's going to avoid surprises and much better buying experience. It's going to let you surf the private listing market, so that way you could possibly get into homes before they even go active on the listings. And then buyers not engaged are going to miss out on these listings and the market that exists not listed on consumer sites, like Zillow, Redfin, all that stuff. They're not allowed to advertise those private listings. You have to work with a realtor to get access to those. New listings will be within reach to make offers, and again, avoiding the chase of the market. So I hope this information was very useful to you. Feel free to reach out if you need any questions answered. I'm always able to set up a meeting with Eric. He'll provide all the clarity that you need to make sure that you're ready to purchase a home. I'm already out there working with buyers and getting ready with some sellers to hit the peak of this market and try to make sure that I can do the best for them in these conditions. And if there's ever a need for anything, just be sure to continue following me, reach out for more information, like and subscribe. All these videos are going to be coming in just for you guys, hoping to bring you the best value as I possibly can. But thanks for stopping by, and I will look forward to seeing you in the market. Bye now.